Hello and welcome to the Friday Market Update. First and foremost, happy Mother's Day to all those hardworking real estate mothers who do way more than their families really know. And we know how important you are to the family and appreciate all you do. So enjoy your special day on Sunday. So, no news is good news, so to speak. So, there is very little economic data that came out this week. And the good news is rates dropped again, creeping down closer to that 7% level. We still have a ways to go, but I'm hoping that we will get there shortly. So many times in a week where there's no economic data, Wall Street traders start to worry and they think of the worst case scenario that could happen. And then they try to anticipate all the bad news. So then the market kind of goes to pot. But anyways, it's like waking up in the middle of the night in a cold sweat as you go down that rabbit hole, wondering if your phone will ever ring again with a new client. So these types of weeks many times can lead to higher rates. Today we saw rates go up a little bit today, but overall the trend for the week was down. So what appears to be happening now are the markets are starting to digest the jobs data, which isn't as rosy as some people claim it to be. Names to be withheld. So Wall Street is now looking for a deal. They're always looking for a deal. And so the question is, what is the deal? So it's the high yields in the bond market. In other words, the higher interest rates that traders can get for the bonds, including mortgage-backed securities. So because interest rates climbed up and were headed higher and higher and higher, now it appears that they may be headed back down. So Wall Street now wants to buy those higher interest rates, those securities, before they go down even further. So they're trying to get the deal. So it's simple supply and demand economics. When Wall Street starts to buy more mortgage-backed securities, the interest rates start to go down. So combine that with the announcement that the Fed last week said that they will start to buy mortgage-backed securities starting in June. They now want to jump in and get a deal. So this should bode well for mortgage rates to continue to drop as the year continues. Remember, it's not going to be a straight line. We're going to have some ups and downs and bumps and bruises, but the overall trend should be downward the rest of the year. So consumer spending makes up about 2/3 of gross domestic product, or also known as GDP. So GDP is really the government's measuring stick of the economy. Now, because the consumer is the key driver of GDP, I personally question big time how long the consumer can hold up. I mean, we already know, we've talked about this many times, that wages have gone up on a percentage basis, but actually the number of hours worked has gone down, negating much of the increases. And we also know that many of those jobs are part-time and many people are getting double jobs. So it's not as strong as you think. So where I see the issue coming in the next few months is a substantial dwindling of savings in the incredibly high credit debt. While April is typically stronger than most months for consumer spending because they get that tax refund check sent out and they have a little bit extra money, this money is going to be gone pretty soon. And before you know it, summer is going to hit. Then you have summer vacations that will just add to this credit and savings issue. And so come the fall and going into the election, I think the consumer could be flat on their back, hoping to be resuscitated by maybe lower rates. So at this point, I think the Fed will start to cut the Fed funds rate here in the fall. So next week is the release of the Consumer Price Index, the CPI. We don't see any major surprises coming. Core inflation will likely drop a tad, which is a positive, but it's not going to be earth-shattering. So as long as the CPI doesn't go up, we should continue to see those rates come down. So last Wednesday, we took an unofficial poll at Las Vegas Pitch in Henderson, and on whether or not that there was more buyer activity and multiple offers now than a month ago. Over 90% of the agents said activity is up. We also know that Las Vegas home prices are up year over year from 2023 to 2024, despite the higher interest rates. So buyers sitting on the sideline right now should seriously consider getting off the fence and buy now, as hard as it is, as fearful as it is. Home values will almost certainly be higher a year from now, given the low supply of homes. So as always, feel free to reach out to me directly to get your buyers pre-approved. get them educated so they can make the right decision for them. So you can also send them to my calendar link where I will go through a free CIA, credit income asset analysis, so they know exactly where they stand now and what they may need to do to get into a home now, 30 days, 60 days, a year. So let's run their numbers. So have an amazing weekend. Happy Mother's Day. And we'll see you next week on the market update. Gaylord out. Bye-bye, everybody.